Happy Wednesday afternoon, everyone. Good afternoon. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. We are so pleased to welcome you to another Wednesday afternoon webcast. Today, we will be speaking with David Burrows, Chief Investment Strategist and President here at Barometer, who will provide us with a brief market overview and, of course, address questions at the end of the conversation.
Thanks, everybody, for joining us today. Here we are in the second week of January. We certainly got a Santa Claus rally to finish the year. Year has started quite well. As the old saying goes, so goes the first 5 days of the year. Can have an impact on the entire year. And so let's hope that that's a good omen. We're probably not going to make any decisions based on that, but it's always nice to start the year strong. Just quickly by way of review, there's lots of different ways to do things. Our focus is trying to identify long-term structural themes that are benefiting from the current backdrop, things that can be revalued over a long period of time. We don't want to own the average company. We don't want to own all the sectors we want to target. And certainly we're in a market where there are some very clear themes and there are some very clear have-nots. So we use the tools that we run, the rules that we follow every day to try to identify sort of clear market leadership, sectors, themes, geographic regions, asset classes that are being purchased where there is an appetite. And ideally, we want to be there early. We want to stay as long as they continue to work. We want to always watch for change, new leadership as it emerges. And certainly there has been new leadership in the market over the last 6 months. And arguably probably started in 2019, got derailed for a little while at the beginning of 2020, but has become very clear at this point. And then there are some periods of time when nothing's working and we're always want to be willing to be defensive when it's required. Or out of big parts of the market. And there are some parts of the market that maybe we want to avoid right now, but ultimately is a very sort of tactical approach. The families that we take care of are hiring us to pick our spots. Everybody can go buy an ETF and hope for the best, but that's not our goal. We've been in a structural bull market since 2013 in US equities when we took out the highs from 2000. They tend to last 15 to 18 years. So 7 years feels like a long time, but it's relatively short in the scheme of a long-term bull market. Equities are strengthening and broadening beyond the US market to global markets, and that's a healthy thing. We believe that the bull market in the S&P is intact, same in the NASDAQ, and we do also believe that we've gone through a generational low in interest rates, which is, again, a structural shift in the market that means what works going forward is probably quite different than has worked through a disinflationary environment. If we're in a reflationary environment, it's a different game entirely. But it takes people a long time to figure that out, and that's the good news. That's what causes flows of capital to shift from one area of the market to another. And when it starts, it goes on for a long time. We've talked about over the last while believing that we had seen a significant low in commodity prices. Again, they follow very long-term cycles, and they pose a separate set of opportunities. Again, at this point, after many, many years of underperformance, very underowned and unloved, many young portfolio managers probably have never owned anything to do with basic materials, but certainly in a world that is stuffed full of stimulus, both monetary and fiscal stimulus, and a world that is starting to look beyond what may be the end of a pandemic, a new business cycle will emerge, cyclical stocks will participate, and this is an area that could give some very significant returns. We know that the stimulus has been significant. We don't have to beat this with a stick, but all around the world, we have been pushing liquidity into the market. And we know the one thing that the adage we all know is don't fight the Fed. And there's a good reason for why they are providing the stimulus, because the world is awash in debt. Right, the Fed's balance sheet is debt as a percent of GDP is off the chart relative to history, and so what they need to do is inflate the value of assets to offset the impact of the liabilities. Ideally, would like to see inflation above the rate of interest they're paying on their bonds, and that helps them over time to inflate away the debt. And we know the last time this happened was in the late 1940s when debt was in a similar spot for developed economies around the world. And we saw a reflationary cycle that lasted over the next 20 years. So significant implications for the dollar. We talked over the last while about the US dollar weakening. That weakening continues. This week, we've had a couple of days where sort of the dollar tried to hold. This is sort of a pinch of nothing in the scheme of things. We are in a significant downtrend in the dollar. If we were to breach this, that would be something. But realistically, it tends to be when you have a move, you'll have a first leg down, a consolidation, and a second leg down, which would be about the same duration, which would take the US dollar index versus the basket of world currencies down into the mid 80s. We're sitting right now at 90 cents versus the basket. So lots of room for things to move to the downside. Realistically, US dollar has been becoming a smaller and smaller piece of global Forex reserves and central banks. They have chosen to hold some other currencies, including the euro and in some cases the Chinese currency, and the dollar tends to follow global Forex reserves. We talked last week about commodities making a reversal out of a 10-year bear market. That's significant. It's the early stages of change. And the metals and mining stocks are a good example. They followed through over the course of the week. They could easily consolidate here for a short period of time after making quite a significant move in the short run. But this is a group we want to watch. In a reflationary environment, stocks should be outperforming bonds. And we can see here bonds are significantly underperforming stocks for the first time in many years. So it does look as though we are seeing a shift in long-term interest rates. First thing that works against a rising rate environment, long-term rising rate environment, is stocks. They outperform bonds. That's what happened through the 50s and 60s. That's what's happening now. When we look at the S&P as we sit today, this is the remarkable recovery we saw off the lows last March. 2 significant legs higher. We consolidated through the fall, looking forward to the election and all that would come with it. Surprisingly, very little volatility really going through October. We rallied into December, and then the S&P consolidated through the early part of December. And here we are, we're sitting just a smidge off all-time highs. Very, very constructive, trading above the long-term moving average, trading above the 21-day moving average, trading above the 8-day moving average. Market is strong. The NASDAQ, very, very similar, consolidated over the course of time between December and the beginning of the year. We broke out to new highs. We're just in a 2 or 3 day sideways patch here. Interestingly, today, Apple and Amazon for the first time in a while led the market. They have gone sideways really since August, consolidating the gains. It may be that growth stocks could have a good little go here, but the net of it is the market continues to broaden. We, of course, care most about breadth. Are there more groups participating in the rally or fewer? We've talked about how dividend growth really in November had a fire lit underneath it, and it has been rallying ever since. Dividend growth stocks, in fact, are outperforming the market as a whole, something they certainly have not done for a couple of years. And this has been a major focus in our income strategy, where we believe if long-term rates are likely to slowly rise, and we've already moved from 60 basis points or 0.6 of 1% in the 10-year bond to 1.2%, back a little bit in the last couple of days. But if that were to continue to slowly work its way higher, then investors want to have a rising stream of income to offset the impact of rising rates or potentially higher inflation. And certainly we are seeing money move in this direction. We talked about how emerging markets and developed markets around the world, global stocks, should outperform in a reflationary environment. This is the emerging markets ETF, breaking out above the highs from 2011 and now challenging all-time highs back in 2008, but certainly outperforming the US stock market at this point, giving us opportunities outside of North America. So as I said, what we care about is breadth. We like to see the first groups turn higher when you're going through a trough, and that would have been, in this case, the tech stocks and the growth stocks and the companies that benefited from COVID. As the summer went on and we started to move more towards getting a vaccine, we started to see consumer discretionary stocks really start to make a turn. And as we got into the fall and got news on vaccines, more groups started to participate, like financials and industrials, and breadth has continued to expand. We will watch for any sign of deterioration in breadth. At this point, there is no sign. When that happens, we raise some cash. I think people know we use our stop losses on existing positions. But what the market is telling us is we are on our way into the beginning of a new economic cycle. That's why economically sensitive stocks are leading. It's why companies that are not economically sensitive are lagging in the market. And there's some very clear leadership. Last week, when we did this meeting, our short-term indicators, we had a couple that had consolidated through the last couple of weeks of Christmas or the holiday season. As we sit today, all of our short-term and long-term indicators have strengthened over the course of the week. They're all positive. Percent of stocks trading above their 50-day moving average is very, very strong. The percent of stocks with positive weekly price momentum, upward trajectory is expanding, but still below 50%. Percent of stocks making new highs versus new lows is very significant. Very few new lows, a lot of new highs, a lot of happy shareholders. And percent of stocks trading above their 150-day and 200-day moving averages still moving higher. Now, if you think about it, 200 days ago, we were going through a trough in the market. So it makes sense that stocks are above their 200-day moving average. But the net of it is, it's not just very large growth stocks. It's not just very large value stocks. It's not just large cap and mid cap stocks. It's large cap, mid cap, small cap, various global markets, Taiwan, South Korea, Japan, some of the European markets. We're seeing strength really around the world in the equity asset class. Now we're heading into earnings. We'll start to see earnings over the next week or so. We'll get about 3 weeks worth of earnings reports coming to market. That means a couple of things. It means, first of all, corporate share buybacks get stopped at this point of the year, leading into earnings. So that is one significant buyer of stocks that comes out of the market. But think about it, the market has been remarkably stable. I mean, if somebody had said to me 6 months ago, around the time of the election, there's going to be an attempt at taking over the Capitol building to overturn the election. There would be people injured. There would be violence. What will the market do? You would fully expect the market to care. But it tells you how strong the underpinnings are, all the different things that conspire together to support stock prices, valuation, earnings estimates. This is the estimates that have what's been happening to estimates coming into this quarter versus what tends to be the case leading into the fourth quarter earnings reports. It tends to be analysts come into the year optimistic, and by the third quarter realize they're probably being overly optimistic and start to scale back their expectations for what the earnings will look like. In this case, analysts have realized perhaps they are overly pessimistic and have been raising their estimates through the fall. And we're getting a very unseasonally typical set of earnings estimates. So we think that likely earnings estimates will well exceed, the earnings will well exceed the estimates this quarter. We'll see over the next few weeks, but that likely would be very supportive for stocks. So earnings estimates getting better, stimulus in place, likely more coming, flows moving from bonds into stocks. There's a lot of support for equity markets beyond just the top line political news. Leadership is not changing. Semiconductors continue to lead technology, the most cyclical part of technology. Inventory cycles are very short in semiconductors. We heard this week that many of the automakers are having to slow down their production because of a shortage of semiconductors. We know that semiconductors go into more and more appliances, vehicles, devices, and this is a secular growth area of the market. We know the banks, as of the election, just took off to the upside. When rates started going higher in the long end, meaning long-term interest rates higher than short-term interest rates, their ability to pay a low interest rate on deposits and lend money at a much higher rate, the spread has been widening. banks are outperforming, and with an expectation of vaccine working its way through the system, less concern about the global economy. And so banks, large banks and regional banks to get significantly outperforming the market. Again, an under-owned part of the market. Industrials, very cyclical after consolidating through the holiday season, turning higher and breaking out to new highs. Transportation stocks, similar. And then also things you would expect to do well in the face of a weak US dollar would be something like Bitcoin or something like gold. So Bitcoin has had a remarkable move, but you have to keep in mind that that has been the history of this asset, going from an under-owned, unknown asset to a few people getting awareness. It goes through a major correction and then rallies from 150 to 14,000 and got a lot of notoriety, and then sold off and consolidated like assets do and became more well understood. We bought Bitcoin for our accounts around the $14,000 level as this first breakout was taking place. We broke out from the absolute highs at 20,000. And of course, we know that it went to $40,000 over the course of the last week and has pulled back a little bit, which you would fully expect it to do. But it looks as though targets are much higher. It's a small part of our portfolios, but certainly is part of a reflationary theme. Gold similarly rallied through the course of 2018-19, pulled back a little bit at year end as it was breaking out to new highs. Again, things consolidate as they move higher, but this group looks interesting. And frankly, the gold stocks are as cheap as they have ever been versus gold in history. Gold miners' enterprise value to earnings before interest, taxes, and depreciation are basically sitting at 15-year lows, meaning if gold prices move higher, gold stocks versus gold likely can move higher faster. Actually, this group has a higher free cash flow yield than the tech sector. Now, obviously very different and certainly an unloved sector, but one that we think could do well going forward. So I've asked Amit to join the call today. One of the things we haven't spent a lot of time talking about recently is the cannabis sector. We're always looking for tailwinds within groups of assets, things that can be revalued where there's structural change taking place. As you know, we've gone through this election. The Democrats are more friendly to this wellness sector or cannabis sector. Amit spent a lot of time covering these companies. We do have holdings. And so I thought I'd ask him to come on and talk a little bit about what this change in the administrations may have as an impact on this sector and talk a little bit about the companies that we own. Amit?
Thanks, Dave. Yeah, it's definitely an exciting time for the cannabis sector and then cannabis stocks in general. And we did see a rally in cannabis stocks after President-elect Joe Biden won the election in November. The Democratic platform, like you mentioned, has been more positive to cannabis itself. Vice President-elect Kamala Harris, under her platform, has promised decriminalization of cannabis, which would remove it from a classified substance list. But just even kind of taking a look at the overall developments that we've seen in terms of a Democratic sweep of the Senate, it just kind of paves the way for more progressive cannabis legislation than we've seen under a Republican regime. Speaking to some of the companies in the sector itself, they're excited about a few of the developments. One of them would be the Safe Banking Act. This would allow cannabis companies to access more traditional forms of banking and potentially list on U.S. exchanges. So when you look at cannabis businesses currently, they can't access banks in terms of loans or even deposit accounts. A lot of them have accounts with credit unions versus Schedule I banks. So this would be a very positive development as cannabis companies could access more traditional forms of banking, possibly reduce their cost of capital in terms of loans versus accessing private debt markets. Currently, even from an operational standpoint, a lot of the cannabis businesses that are conducted currently are cash businesses. So customers are actually going into retail outlets and paying with cash versus credit cards. So that changing is definitely a positive. Any kind of ability to list on U.S. exchanges, obviously a positive as well, as they could access more capital through the capital markets themselves. The MORE Act is another one that would be of benefit to the cannabis companies themselves, expungement of records, also changes in kind of the tax regime. Currently, operational taxes, operating costs aren't deducted from revenues, so the companies are paying a higher level of taxes, and cash flows are impacted. So there could be a positive inflection in terms of cash flow itself, and then to a broader extent, any kind of developments towards federal legalization would be a positive. You could see more typical CPG companies look at entering businesses through acquisitions as well. And we've seen the companies rally on the back of this, anywhere between 30% to 50% over the time span. A lot of them have come to market and raise capital in anticipation of further growth capital and M&A. So, just to highlight a couple of the names. So you have the chart up there. For Curaleaf, this is one of the holdings that we hold in the portfolios. They're one of the larger multi-state operators listed on the Canadian Securities Exchange, but conduct business in the U.S. on a state-by-state basis, have a national footprint through many of the states, and are actually one of the larger multi-state operators, operating very well. They recently came to market and raised $275 million in an oversubscribed equity deal. They've earmarked that for growth initiatives as well as M&A. They have a presence in Massachusetts, where they have a #1 market share, as well as Connecticut and New Jersey. They're also in Pennsylvania, Maryland, and Florida. So a big exposure to the East Coast. TerrAscend is another company that we have exposure to. TerrAscend is also a multi-state operator listed on the Canadian Securities Exchange. They have operations on the East Coast in medical markets such as Pennsylvania and New Jersey. Interesting developments in New Jersey is that they will be going recreational during this year. So that's a positive for the company. TerrAscend also came to the market earlier this week. They raised $224 million in an oversubscribed private placement that was predominantly placed with U.S. investors. So even as U.S. investors look at the space, trying to get ahead of the curve there. So that was a very positive development. And operationally, these companies such as TerrAscend and Curaleaf are generating strong EBITDA margins and performing very well. And lastly, to highlight, Columbia Care is another multi-state operator that's vertically integrated that we like. They recently came to market as well, raising $130 million in an equity raise. It was also oversubscribed. So we have these companies sitting on a war chest of money earmarked for growth, for M&A, and operationally. During the early stages of the pandemic, cannabis was deemed an essential service in the U.S. So all of these companies were able to have operations open, and they actually saw demand increase. So as we've seen some of the quarters put up by the companies, they've been very robust, very strong revenue growth quarter to quarter, year over year, and even more importantly on the profitability side, very strong EBITDA margins at 30% plus. So overall, a great setup operationally as well as on the regulatory front with a democratic administration under Joe Biden.
Emmett, two quick questions. The first question is, what inning do you put this cycle in for these companies?
Yeah, that's a great question. It's the way I look at it, and when you speak to the management teams of the companies, it's still very early. If we're looking in terms of innings, it's your second or third inning here, and given the fact the access to capital, the access to banking, these being cash businesses, and even in terms of investors that can look at these names and invest. Many institutional investors can't invest in these companies due to the fact that they are illegal on a federal level, that cannabis is illegal on a federal level. So any kind of developments there opens up a wider lens of investors that could look at the space and invest and get involved. And even from a valuation perspective, still trading at reasonably cheap valuations for the amount of growth that we're seeing on the revenue line and the EBITDA line for these companies.
I think what's interesting is we watch these deals come over the last short while, and despite being relatively large deals, having virtually no impact on the share price. The appetite for shares was there. Often when you get a company issuing shares, you're going to knock the stock back, and it'd be done at a big discount. But these companies have really come through and gobbled up the stock and moved on. So I think this is going to be an interesting space, and certainly, it's not for everybody, but it's a large market and one that we are participating in. So thanks very much, Amit, for joining us today.
Not a problem at all. Thank you.
So look, just to wrap up, we move in incremental steps, and we have been moving in incremental steps all the way through the year to reduce our exposure to assets that do poorly in a reflationary environment. They tend to be the groups that are very broadly held, things like communication services, like the telcos, the consumer staples, real estate companies, the utilities. We have reduced our sort of overall growth exposure. Technology is about 30% of the US market. If you look month over month, we've moved that down to about 25, still a significant piece because we have lots of cyclical tech exposure, and there's still lots of disruption taking place. But our exposure to industrials has been steadily moving higher. Our exposure to financials has slowly been moving higher. We'll get some earnings this week from large financials. Our materials holdings have become more significant. And so ultimately, things are working their way higher, and we continue to be in these places. It's nice to see themes start to trend and become persistent and become resilient. The fact that the market has not been derailed going through the conflict that we are going through around the change in administration is a testament to the strength of this market. It is likely the market's going to bounce around a little bit over the next few days until we see the Biden administration safely ensconced in the White House. But I think the underpinnings are really quite strong. Year has started out remarkably well. Our equity pool, our long short pool, our macro pool are all sharply higher. Income pool is having a great move. And so we're really participating right off the hop. We will watch for any sign of weakness. Canadian dollar has been strong. So as we've talked about in recent meetings, we are remaining hedged back to Canadian dollars. So while we have lots of US holdings, we are hedging out the currency risk back to Canadian dollars because if commodity prices move higher and global markets move higher, it tends to be Canadian dollar probably moves higher. So we'll get defensive if we need to, but at this point, there's not a ton of change in portfolios. Just to leave you with one thought, in the macro portfolio that we run, which is a multi-asset long-short portfolio, if you look at our exposure there, we can be anywhere. We are about 60% US equities. We're about 20% emerging market equities. We're about 15% global equities. The balance is made up of basic materials, which is about 30%. That means we have a little bit of leverage. And we are short fixed income, short 30-year, 10-year, 5-year, and 2-year US Treasury bonds and global sovereign bonds. We are also short the US dollar, but again, hedged back to Canadian dollars. And as things change, we'll continue to moderate the portfolio, but think we're in a pretty good spot. With that, if Pam is on the line, we'll take some questions. I think we lost her early in the call. It looks like there's a couple of questions. I'll see if I can see them. I can't pull them up on my screen. So it may well be that we're not having questions this week. Pam, are you there? Oh, I don't think that she's there. Okay, well, with that, listen, we appreciate you all taking time to join us on the call. We are going to do a call. It'll either be next week or the week following, specifically around Bitcoin. We had a lot of questions from from clients. We participated in the first Bitcoin ETF in Canada when it was launched, and I believe that Fred Pye will join us, who's the CEO of the company that launched the first Bitcoin ETF, to talk to us a little bit about that market. And I am hoping it will be next week. If it's not next week, it'll be the following. If anybody's got questions in the near term, please don't hesitate to call us. I know there's a lot going on in the world, and we're happy to answer any questions that you have. So Amit, thanks so much for joining today. Thank you everybody for taking a half hour of your time. And if you have anything you'd like us to address in future meetings, please don't hesitate to email me, dburrows@barometercapital.ca, or Pamela. And certainly don't hesitate to follow us on Twitter. We put up some interesting stuff from time to time. @BarometerCA is my Twitter handle. And we'll try and update in between meetings if there are significant changes. So thanks so much, everybody, and have a great night.